Hey guys, welcome to today's session. My desk is slowly raising at the minute, so let's wait for it to get to the top and then we'll jump straight into it. It's a bit of an awkward transition to start the session, right? I thought it would have been up to the top by the time it started, but I hope everyone's having a good day. Hope you've all had a successful trading day and start to the week. Now we'll give everybody a few minutes to join the session, and then we'll jump straight in. If you haven't been to one of these sessions before, they're my absolute favorite session to run week in, week out, and it's our strategy development sessions. So we take a look at some of the statistics that we provide you at Darwinex and Darwinex Zero. I usually pick on somebody in the audience, so if you're willing to let me take a look at your Darwin and analyze your results and your trading behavior, then that would be hugely appreciated. And I will give you some real-time feedback into some things that you're doing well and some things that potentially could do with some improvements. So as I say, I'm going to give people a minute or so to join. If you want me to take a look at your Darwin, then feel free to pop it in the chat and I'll load it up whilst we're waiting. For the guys who are interested, also the Darwin on the screen right now is the one that I was talking about a couple of weeks ago. It's one of my newer Darwins. I've been building a portfolio of automated strategies. So I code basically beta strategies, things that have small amounts of edge. I'm not looking to deploy singular alpha. I'm looking at single strategies that return 1 to 2% per year, combining them into a portfolio, and XAQP is the finalized result. Now, it went live Monday of this week, and I've been scaled up pretty aggressively. I can't lie. I was quite shocked when I first saw the way that the risk engine interpreted the results. Now, at signal account level, my account is at 1.7% with a max drawdown of 0.3 or 0.35%, I believe. And so you can see the risk engine has been quite aggressive with the way it scaled me up to a return of 9% in 1 month, which is more than I wanted it to be. So let's make that clear right now, with a max drawdown of 1.9%. So based on my calculations of all the back tests and the strategies that I put together in this system or in this portfolio, I think that that max drawdown might push out to about 10 to 15% over, an extended period of time, which is okay. I'm okay with that. At master level, I want to keep it 2 to 5% at an absolute, max. But yeah, like I say, I was very, very surprised to see the results of the risk engine scaling me up. Just to take a look at my value at risk. By the way, to the guys who have just joined, whether you're watching on YouTube, Instagram, Twitter, whichever platform you're watching on, or Discord, if you want me to take a look at your Darwin and analyze your results and your behavior, just pop it in the chat and I will take a look at it for you right now. So as you can see, my value at risk is fluctuating between, it began at 1, and then I started integrating a few more strategies. Right now, there's 9 systems running simultaneously. And so you can see it's kind of increased a little bit over time. We currently sat about 1.35% value at risk. So it's only increased by 0.3%, but that's due to me adding additional strategies in. Like I say, I have 9. The target is to have between 20 and 30 strategies all running simultaneously. However, as I integrate more systems, I will reduce the risk exposure of the ones that are currently running. So what I don't want to do is flood the portfolio with too many strategies and the risk just increase because I'm just adding exposure. What I would like to do is increase exposure from a diversified perspective from each strategy, give each strategy a little bit more exposure, and then reduce the individual or the singular exposure from each strategy. So for example, on all of the strategies right now, I'm risking roughly between $40 to $50 on pretty much every trade. There's 1 or 2 strategies where that might push to about $100. But as I go and add more systems to the portfolio, I will probably reduce that from $40 to 30, maybe 35, from 100 to 80, just so that I keep my VAR pretty steady as we move throughout. But yeah, to recap, 9%, I was not expecting that at all. It's put us in the top 220. I think when we went live, it was about 140. So we've dropped down because today you can see that we're floating. No, we took a losing trade this morning. We're floating up. Gold is near target and we're at break even on a WS30 long as well. So you can see that this is updating in real time, but we're slightly down today. But yeah, because it's automated, it's just running in the background. I don't have to worry too much about that sort of stuff. For the guys who've been following me in these sessions for a long period of time, you know that I'm always open about what I'm doing as a trader. I used to have a Darwin HDMY. I don't trade CFDs anymore. I took a complete step back. I had a really rough start to this year, but I've ended up kind of leaving that side of things behind, the CFD stuff, really focusing on automated strategies for my CFDs and focusing on futures trading elsewhere as well. So yeah, anyway, enough about me. Is there anybody who wants me to take a look at their Darwin before I just keep talking about myself and my own systems? Which I'm not sure if that's what you guys want to hear. We can do that in today's session. If nobody wants their Darwin looking at, I don't mind going over the processes to build this and how I'm looking to adapt it moving forward. It's always a little bit trickier when you're looking at a portfolio of strategies, because the data doesn't distinguish between which system is which, or which data is for which system. What I mean by that is when I'm analyzing the trade by trade breakdowns using my effects book or the MetaTrader statements, I can take a look at the magic number. I can see which strategy is performing well. Whereas when I'm looking on Darwinex, I can't actually see that because we don't have that information available, at least on the front end anyway. But you can see my signal account is currently up. I forgot I can show you this. It says 1.87%, but it's slightly less because it hasn't updated for today's trades yet. It doesn't say the max drawdown, does it? No. Okay. Rapolas, how we doing? BXTM, but mine is under 6 months old. Let's take a look. I'm sure we've looked at yours before, haven't we? Have we taken a look before? I can't remember. This sounds... What's your account size? Well, it's the CFD Darwin, so it would be $100,000. I'm presuming that's what you're asking. Did we? I'm sure we've looked at this before. Did we, Rapalas? I've got you saved anyway. I've got you were in my search bar, so I'm presuming that I've taken a look at it in the past. This is this signal account I'm running, by the way, so you can see. Okay, we had a chat about VAR because I was worried that it was too high. Okay, I'll take a look. So yeah, you can see currently a break even on WS30, running nicely on gold, but needed to come down here. The only problem is because I have multiple strategies running on an asset like gold, I have a couple on WS30. I think I have 4 strategies on gold. As it comes down, it is going to trigger another short, which is obviously going to increase my exposure, which is annoying, but I can't do anything about it. Usually the strategies are pretty uncorrelated, so I just have to take it as it is. Yeah, Reed. So Reed asked what's my account size, which is $100,000 because it's a CFD Darwin. And then Reed said, you said about risking about $50 per trade, wanting to confirm the account size. Yeah, so it's a $100,000 account. So every trade is roughly between $40 to $50 risk, with the occasional ones being about $100, based on the strategies that I have active in the portfolio right now. However, with that, so I was just reading Snowy's comment. With that, the potential reward of each trade usually goes from like 100 to 250. So I do have I have a lower win rate with quite a higher expected return on each individual position, which is why I'm keeping my risk lower. Hence why my value at risk is at 1%, and I'm being scaled up by Lord knows how much. In fact, I don't think it's showing my Darwin risk multiplier at the moment. No. I don't know why that is. I don't know if it's just not updated. But I would presume it's about 4, maybe just over 4. Snowy said, recently we learned about the 400 position limit. Can't really pile that too many strategies into one Darwin. It depends. So my strategies, I mean, the maximum amount of trades I've ever had on this Darwin at the moment, which hasn't been running that long, but with the back tested data and since running it live, the maximum amount of trades has been 3. So I've not had over 3 trades. That's with 9 strategies. PGLM, which is Enrico, or as you guys know him in the Discord as the Rango, he has about 40 strategies, I believe, all running on his account. And then, sorry, somebody's ringing my doorbell. It might be my kids. Yeah, it's my kids. He has about 40 strategies. And then Blaine, who is the trader behind IME, also has over 20 strategies running on his portfolio. So I think it really depends on how you trade. If you're trading with a grid or martingale system, then yes, you're probably not going to be able to use, or you'll probably fill up that 400 position limit. But if you're trading FIFO strategies the way I do, I mean, I have 1 or 2 that aren't FIFO compliant, which basically means first in, first out, which is usually a standard amongst US hedge funds, where basically you cannot enter a second position, so you can't DCA into any trades. All my trades have stops and targets, so it's you're in until you're out, basically. So I will never, ever, ever likely come close to that 400 position limit. Snowy said, okay, I'll need to think about reducing trades per strategy. Well, it depends on the strategy, right? But the only thing with that is, obviously, if you have a strategy that takes insane amounts of trades and piles all of those trades in together. I don't know if you've watched the video about positions versus trades. So it's in the Discord. It's on all of our social media. It's like a 60-second video that I recorded, and I break down the difference between a trade and a position. So your trades have like individual risk exposure, right? But the way that we calculate it is we combine all of your trades into a synthetic position. We then compare the deleverage of that position compared to the euro dollar so that we can work out your actual combined exposure amongst the whole position. So if your position exposure increases dramatically because you just keep peppering trades, then your value at risk will, of course, increase, and the risk engine may get involved in your positions if your deleverage expands outside of the regime of what you usually do. So that's just something to be aware of. But yeah, I mean, as I always say to every single trader, just do what you do best. Trade how you know best. If that's throwing 1,000 trades in one day, that's throwing 1,000 trades in one day. I'm not here to tell you what's right or wrong. I would just always be cautious. Like, know your exposure outside of Darwinex. I mean, I tried. Like I say, I was a little bit surprised to see I'd been scaled up so much. But then I do keep my risk outside of my Darwin really, really low, because I know that on some of my strategies, for example, I think I've got one where the maximum losing streak was 22 trades in a row, which is roughly at the risk I'm running that strategy, it's about 1%. Okay, so it's a 1% drawdown, but that's 22 losing trades. So I'm aware of that in my head, which is why I keep the risk super, super low. Now, when I get those 22 losing trades on my Darwin, which is scaled up by 4 or 5 times, that's going to be a 4 or 5% drawdown, right? Just on one strategy. If another strategy goes into drawdown at the same time, it could be worse. But the whole point of running the portfolio is so that if one strategy experiences a drawdown period or just a period of lackluster performance, hopefully the other strategies will kind of uplift the portfolio as a whole, right? So I've got one strategy since running it. It's a gold strategy, which has been the one that's outperformed. I think it's made pretty much like $1,400 out of the $1,700. However, historically, it's one of the lesser performing strategies. So it's kind of supported while the other strategies haven't performed, it's supported the portfolio. Now I'm presuming when that goes through a drawdown, the other strategies will kind of uplift the portfolio and they will each have their day in the sun. Again, I'm talking about myself too much. So let's jump into BXTM. So this is, I mean, I apologize if I'm saying it wrong. It's Rapolas, from our Discord. Just correct me if I'm saying that wrong. I'm sorry, just correct me. Us Brits, we tend to have a way of butchering names, unless they're easy to say. So as you mentioned, it is less than 6 months, which is usually what I ask for. I don't think you can get a significantly I don't think you can get a good enough look into somebody's profitability or experience when you've got 3 months. I mean, this is probably even less than 3 months because May hasn't finished and March you had a 0.02% return. So it's just going to be too difficult to get a real view of your trading. I mean, the great thing is you've got 100,000 euros in DarwinIA, which is like fantastic. But let's take a look at a few things before we jump in. Okay, so 130 trades. Yeah, it's not enough really to kind of get a good idea of what you're doing. This was it. I remember this. Let me grab our direct messages up, because rather than going through and doing a bit of analysis, we'll talk about what you asked me in direct messages. So you asked, hey Garen, hope you're doing well. I have a question about my Darwin BXTM. I know you analyze with a history of more than 6 months, but I'm worried about my value at risk. I'm new to Darwinex and want to set it up correctly. During the calibration phase, I believe I made a mistake. I traded with a 1 lot size in the Signal account, and in that case, my highest value at risk was 17%, but it's currently around 15%. Also, the risk ratio of my Darwin live trades is 0.37. Before it was 0.49. I thought reducing the lot size in my Signal account would fix it, but I'm not seeing the results yet. Could it take more than 45 days to refresh everything? And which was a fantastic question, right? And what I liked is that you approached it with kind of a holistic view. You was actually asking advice. You wasn't just saying, "Oh, the risk engine's doing this. I'm being thrown out because of my value at risk." It was nothing like that. You were genuinely curious about what's happening. And what I said to you was basically that the risk engine does have a 45-day look back period, but what it does is it analyzes your performance within that 45 days and then compares it to a 6-month average. Now, of course, you don't have a 6-month average yet because you've only been around for 2 or 3 months on Darwinex, but it will take into account all of that behavior. So yes, it will take roughly 45 days, but it can take slightly longer. But you know, going back to my original point back to you, Rapalas, was I actually don't think there's anything to be concerned about here. I always say under 30%, I'm not ever concerned about the risk exposure of the trader anyway. But all I think you need to do, if this is too high for you to stomach, just slowly reduce it over time, which looks like that's what you've been doing. So you was messaging me about 15%, which must have been roughly about here, right? And you've been slowly bringing it down over time. So I'm presuming that you've lowered your size at Signal account level and tried to bring that down. Now, what's important here is that a high or low value at risk doesn't necessarily mean that you're a good or bad trader. It has no correlation whatsoever. Some traders perform better with a lower exposure to the market. Some traders perform better with a higher exposure to the market. Every person is different, and every person has, you know, a different approach. And who am I to say something's good, bad, right, or wrong? When we're looking at it mathematically, the value at risk of the S&P 500, which is kind of an investment benchmark, right? We all know that if you can't outperform the S&P, you may as well just buy the S&P and sit and hold. Now, that averages what? 10 to 12% return per year. So your job as a trader is to beat that benchmark. Now, the S&P's volatility is 6.5% value at risk, right? I'm not going to get into too much of what that means and how it's all calculated, because that's what I do in the session tomorrow. So come back at 4 p.m. tomorrow, or watch our recordings on YouTube or Twitter, because I have every single session that I record. It goes onto those platforms. But this effectively means that you're taking not even 2 times the amount of risk as the S&P 500, right? So realistically, with that framework in mind, you should be achieving a minimum at Darwin level of 20% return per year, because you're taking twice the amount of risk or volatility. Therefore, you should be taking twice or making twice the return of the S&P on average. Of course, you might have a poor year where the S&P outperforms, but I mean, you know, over a long horizon, you should be doubling the return of the S&P every year, because you're taking double the risk. Now, obviously, we risk adjust. Sorry, I'm talking about Signal account level, not Darwin, because your Darwin will always be risk adjusted to 6.5%. So you need to beat the S&P at Darwin level, which would be what, 10% per year. Now, your Signal account is roughly going to have to do 20% a year. And this is just to remain competitive, right? You have to beat, firstly, you have to beat inflation. Otherwise, you may as well just sit in cash. Then you have to beat the S&P. Otherwise, you may as well just move all your cash to the S&P. And then you have to beat your peers. So you have to beat other traders. You have to, and this isn't just in Darwinex, this is as a trader. You know, why would an investor come to you as a trader? Again, I'm talking outside of Darwinex, inside of Darwinex, I don't care. Why would an investor come to you when they can either buy the S&P, sit in cash, get interest rates from their bank, or go to other hedge funds or other traders to invest their capital? You have to remain competitive at all time. And this is why we level everybody's risk, so that when I say remain competitive, you're remaining competitive from a risk-adjusted standpoint. So, you know, Snowy is not taking more risk than Rapalas to generate a return. We adjust their risk so that they're taking both of them, sorry, are taking the same amount of risk to provide the return to the investor. Bit of a long-winded way to say your value at risk is not to be concerned, because generally, and this is a general rule of thumb, most traders I meet and most traders generally have a higher volatility than the S&P anyway. It's very hard to outperform the S&P, just as a general benchmark. If you do, you're part of the 10% of traders who are profitable. But most trading strategies, intraday, scalping, position trading, they all have a higher value at risk than buy and hold in the S&P anyway, because it's much faster. There's more room for error. The drawdowns are generally larger. Like, what's the average drawdown on the S&P? 20%, maybe in a bear market. Of course, we have black swan events and we have times where the S&P goes further into drawdown. But generally, especially over the past 10, 15 years, if you just bought and hold, you wouldn't have had too much volatility, apart from COVID and, you know, all of that sort of stuff. And maybe the recent tariffs. But yeah, so that was all I wanted to say about your value at risk. Now, we'll take a quick look at your assets. I don't want to do too much of what I usually do because I don't think we have enough information. But we'll take a quick look at this. So you've got a CFD account. 35% of your trades are in FX, 41% in stock and ETFs, 10% commodities, 14% in indices. Now, roughly, in fact, we have it in here. Got a combined win rate of 43%. So if we take a look on an individual level, oh, that's interesting. You've hemorrhaged your return on FX. But with roughly the same amount of trades with the same win rate on stock and ETFs, you've actually made 4%, which is a disparity of, what's that, 2.13, 5.13, almost 6% difference between the trades that you've taken on stock and ETFs to FX. Again, it's only 2 months worth of data, so I'm not going to say drop FX trading because you just haven't done enough at this moment in time. But again, even more interesting, your commodity trading, you have a much higher win rate, less trades, and a higher return, the highest return out of all asset classes that you've traded. Now, again, I don't want to put too much emphasis on it because I just don't think we have enough data at this moment in time. But you've taken less trades, you've won more, and you've made a higher return. So you've took less market exposure to make it better, to win more trades, to make a better return. Like, that's the goal of every single trader, right? Take less risk, make more reward. And win more trades in the meantime, hopefully. Now, I would be monitoring this moving forward, and I'm going to use this disclaimer for everything that I say in this session, just because you don't have much data, is you have to monitor this moving forward. Because what you might find is that if we're a year down the line and the statistic, like, this isn't just a coincidence or the specific market trend that we've seen over the past couple of months, but if this is you having a strategy that works better on commodities than it does on other asset classes, why bother with the other asset classes? Like, why not just focus on trading commodities? You might have an easier life, make a better return. But again, it's difficult to say at this point in time. You just don't have enough history as of right yet. I'm just going to check for any comments on social pages. Sniper ASG asked, how can I become a fund manager with this platform? So great question. So that's on Instagram. So how can you become a fund manager with Darwinex Zero? So we're basically an incubator for traders to eventually manage investor capital. So you have to certify and build your track record. So you can do that for free, or you can pay a subscription to Darwinex Zero. So you can pay 38 euros a month to access our software through Darwinex Zero, or you can open an account with our regulated broker, FCA regulated broker, I should add, at Darwinex, and then you trade your live account so you can keep whatever money you make and you're not trading a virtual account, and build your track record there. So you're basically just proving that you can actually trade. We will reward you with what we call DarwinIA allocations over time. So we will give you short-term incentives to keep building your track record where you can earn performance fees. And then eventually we have an investor marketplace. When you hit DarwinIA Gold, if you go through Darwinex Zero, you'll get exposure to the investor marketplace. You get exposure on day one if you trade through Darwinex. So you don't have to hit DarwinIA Gold. Now, once you've got exposure to investors, it means that people can allocate capital to your strategy, which therefore would make you a fund manager. You come under Darwinex's fund management license. So we are, as I said, an FCA regulated broker and an FCA regulated asset manager. And we also have our own hedge fund as well, where we allocate our own capital and third party capital to the traders in our platform, which in fact, I will show you right now because I think it's an interesting topic to discuss. So that's how you would become a fund manager through Darwinex. And then eventually, as your track record grows, you can become part of Darwinex Pro, which is where you can basically operate as your own hedge fund using our infrastructure, using our software to take on investor capital, charge performance fees for managing that. Now, as I said, we have the index, which is the Darwinex hedge fund, which is about to hit a new all-time high, which is exciting. Can we see what the all-time high is? 220.48. So we're about 1% away from all-time high, which is great because when Trump started coming out and playing about with all the tariffs, we did see a drop off as the majority of traders, especially the traders that I looked at, did struggle to trade through that period of time. Now we've recovered and we're pretty much working our way back up to an all-time high. Now the index, or what's known as the INDX, is a hedge fund that's run by our team at Darwinex Labs, which is our in-house hedge fund team. We allocate capital to, I think there's just over 100 traders or 100 Darwins in the index as of right now, and we disperse the capital between all of those traders. We monitor it basically on a day-to-day basis, so we look at the exposure to each traders and we judge it by performance, and we will alter allocations based on recent performance. So currently, it's got a 5-year long track record. It's listed on Bloomberg right now, and it's going live to retail investors and professional investors very, very, very soon. I believe in the next sort of month or so. Over the past 5 years, it's done 219% return with a maximum drawdown of 12.27%. So going back to what I was talking about when we're comparing to the S&P as a benchmark, this has far outweighed the performance of the S&P over the past 5 years with less of a drawdown. So risk-adjusted returns-wise, it is far greater as an asset. Now, the great thing with this, and this was a conversation that I was having with somebody the other day, is that investing through Darwinex, you're investing into a regulated asset management company anyway. We also provide to this is applicable to most jurisdictions around the world, and it does differ depending on where you live. So in the UK has a different one to if you're from Europe, different to if you're from America, but we offer insurance to all of our investors as well. So you're covered up to X amount from capital invested into the platform. So realistically, we beat the S&P on security because you have insurance, and none of this is financial advice, by the way, and past performance is not indicative of future results, but you have insurance on the capital that's invested into Darwinex. We are a regulated asset manager. There's less volatility over the past 5 years than what we've seen in the S&P, with a greater return. And the best part about this is that it's market neutral. So the S&P needs the market to continuously go up to generate a return. The index doesn't. Right, we have traders going long, going short. It's not. It's basically a directional neutral. Is that how you would say it? Directionally. You know what I'm trying to say. It doesn't matter whether the market's moving higher or lower because we have intraday traders trading both directions. That's why I love the index so much, and that's why I think the index is kind of the future of Darwinex, and it benefits everybody. Benefits investors because they're getting a fantastic return, benefits traders because there's more capital flowing through Darwinex that's going to our traders, and it benefits us at Darwinex because, of course, we make money operating as a hedge fund, so it's a win-win-win for everybody. Anyway, let's get back to it. I'm going to leave BXTM right now, and we're going to go over it in a couple of months because I just don't think we have enough data as of right now. But we have had Alpha Wolf in the Discord provide their Darwin, so we'll take a look at that as well, which is OCWT. Mad Alpha 1A. Let's take a look. Okay, so 1, 2, 3, 4, 5, 6, 7, 8. Okay, so 8 months long in record. I mean, it's a bit of a shame because you started in a drawdown period, which is why, not why, but why we go down first before we come up, which is unfortunate. But it is what it is. 'Tis the nature of trading, right? Ended last year with a strong December, and then you've come in this year and you perform pretty well. I mean, to me, anything that's not red month on month this year has been pretty good performance, because I think the markets are calming down now, but over the past couple of months, it's been a extremely tricky one to navigate. So we've got a max drawdown of 10.6%. I'm trying to figure out where that is. Okay, so that's from this peak here, from your initial peak to the initial trough, which again is why I was saying it's unfortunate. But it is what it is. You've recovered and you're now up 9% or 20% from the lows. So great work there. Most traders would have sacked it in down there when there was down 10%. But you've clearly stuck to it and you've traded well. And you've managed to get out of it. And this kind of looks similar to this anyway. So it looks like you're probably used to these kinds of periods. So props to you, man, for sticking at it and carrying on. You're now managing 60K. So again, congratulations there. And you need another 11%. Okay, you're going to have to get, what, 15 more percent, I believe, until you're eligible for gold. So maybe by the end of this year, if you keep performing well, hopefully you'll be migrated into gold and be open to investors. But again, that just comes from having that annoying 10% drawdown at the beginning, because you have to make 2.5x that drawdown or that risk to return. I can't even get my words out. You have to make 2.5x the return to drawdown ratio. And if your max drawdown is 10.65, you're going to have to make roughly 27% return before you migrate to gold. Let's move on to assets. So you trade Forex, I believe. Okay, 100%, 6 assets. So Aussie dollar, interesting. Your Aussie dollar maxi, right? So the majority of trades on AU, few on dollar yen, few on pound New Zealand, few on dollar CAD, one on Aussie New Zealand. This is the most random set of assets I think I've ever seen somebody trade. I don't know why. Maybe you've got a rationale for it. How come you specialize so much in the Aussie? Are you from Australia? Because it just seems like a strange bunch of assets to trade. Limits a formula. What does that mean? But yeah, I mean, I see why you do, because you've got a fantastic win rate on Aussie dollar, 79%, which is fantastic, with a positive expectancy as well. So what you don't want to have is a great win rate, but you have a really crappy expectancy and you don't make money on that asset. Nobody wants that. But you are making money on an asset where you have a positive expectancy, a positive win rate, which is great. And it looks across the board like you do have a pretty solid win rate across the board, which is interesting. You have I think your combined win rate is probably about 78%. Okay, which is fantastic. Your payoff ratio is a little bit low at 0.35. So you are up against it. Even with such a high win rate, you have to keep that win rate really high, because the payoff ratio is basically your average risk to reward, right? So for every 1R loser, you're taking a 0.35R winner. Okay, it's a formula that only works on Aussie dollar. Okay, makes sense. Now, you can, of course, make money with a high win rate, low payoff, and a low win rate and high payoff. I think if your payoff ratio is so low, you do make life hard for yourself. So if there's any way that you can find to increase your payoff ratio, which we'll take a look at in a moment, I would definitely work on investigating that. You probably already have. So I might be beating, a dead drum, but it's just worth considering. I would presume, seeing as though you're saying it's a formula, that this is automated, although it might not be. So let me know whether it's fully automated or whether you're actually trading this manually. The reason I ask is because the next thing that we cover is kind of less relevant for algorithmic traders. While I'm waiting for you to say that, we'll take a look at your return distribution by day of the week. Now, this is always an interesting one, and one that I always find fascinating. And it basically shows how profitable you are on certain days of the week. Now, with a short time period, you can't really take too much from it. But as it grows over time, you really can find out where your edge is present. And I'll give you a great example in a moment. and why I cover this in so much detail usually. So your worst day is Monday with a -5% return, then Thursday with a -2% return, and then Tuesday, Wednesday, and Friday are all winning days, which is strange. Usually it's the other way around, but you know, everybody's unique. Tuesday 3.2, Wednesday 4.05, and Friday 7.89%. So generally you like to finish a week off strong, which is great because you should put your foot down on the gas on a Friday if that's the case. The reason I say this is interesting is if let's take a look at THA. So this is one that I was looking at earlier today. So THA, for those who aren't aware, it's the Darwin with 10-year track record and 23 million under management through Darwinex. So it's our most successful trader on our platform. They've got an 819% return over 10 years with a max drawdown of 14%. What was I showing? Assets and time frame. So if we take a look at their return distribution by day of the week, remember this is over a 10-year period, right? Look at the disparity between their top day and their bottom day. This trader's done over 800% return in 10 years, but they're losing trader on a Monday, basically, right? They have lost 8.37% trading Mondays for the past 10 years. Now, when you look at their Thursday, they've made 200, and just to note, this is non-compounded returns. Their 800% is compounding returns. So they've made 225% or 226%, I should say, on a Thursday. Now, you tell me, you tell me how you process that information. Is Atu, who is the trader behind THA, is his edge as present on a Monday as it is on a Thursday when you look at this statistic? Probably not, right? Now, I know Atu trades specifically macro events, so he will wait for a news release and then he will trade the move thereafter. So when we're looking at Thursdays, you might be looking at like US data like FOMC and stuff like this, which might explain why he's more profitable on those days, because there might be a little bit more volatility. But what my point is here is you really need to highlight where your strategy outperforms and where it underperforms. Now, a concept that I always talk about, and the guys who come to these sessions on a weekly basis will probably be bored of me talking about this, but I think a lot of traders would benefit from implementing something called a risk barometer into their trading. Now, this is where you don't have to specifically change anything about your trading strategy or the way that you approach the markets, but you just change the way that you or you amend the way that you play the probabilities. So, for example, taking a look at this, I would argue that Atu or THA has a much higher expected value on a. In fact, I wouldn't argue. THA has a much higher expected value on a Thursday than he does on a Monday. Okay, so should he be trading the same amount of risk on both days? Should he be getting up early on a Thursday, mapping the markets out? That doesn't make sense the way I was framing that sentence. Is it more important for him to wake up on a Thursday on time, get his routine nailed in, make sure he's at his breakfast, drunk some water, gone done his exercise, and at his desk within his tradable hours? That's more important to him on a Thursday than it is on a Monday, because his edge is more present. Should he push more size on a Thursday? Again, arguably yes, because his edge is obviously more present on a Thursday than it is on a Monday. Now, I would actually argue for Atu that it doesn't even make sense at this point to trade Mondays anymore. Like, it literally doesn't even make sense. He's basically never made money on a Monday. There was a peak here, so you can see he's underwater here. He has a peak. It doesn't show you the date. It's probably like a year in, and then he's been underwater ever since. At that point, 10 years in, I'd be like, sod this. I'm taking Mondays off. I'm not even going to trade it anymore. Now, clearly he doesn't, and there might be a reason for that. So he might trade Mondays because it outperforms when the other days underperform, whatever reason he has. But I would argue, looking at this, that it's pointless. And that's why I always put so much emphasis on this, because when you start to see a pattern like this, it's not that you have to drop a trading day. We're talking Atu has 10 years experience, right? This has got 8 months. So you would never make a decision based off of that. But if this starts like if this continues and, you know, your Monday just keeps dwindling over the years, you know, you've got to look at approaching it and going, well, clearly something's not working. So even if I continue to trade Mondays, I need to figure out what's going wrong. Why am I performing different on a Monday to, you know, a Thursday, a Wednesday, a Friday? Is there something that I'm doing in my own personal life? Like, is it that on a Monday you have to get up early for your 9 to 5? Is it that Monday is the day that you go and drop your kids off to school and you only trade London sessions, so you're rushing your trades in the morning? Or is it that your edge just isn't as relevant on these specific days? And again, it's something I always talk about is the way you trade can have an effect on this. For example, if you're a mean reversion trader, then probably Mondays are going to be one of your worst days, if not the worst day. Because what you're going to find with a mean reversion strategy is that you need something to mean revert. So generally, you'll need a couple of days price action within a week to get a better mean reversion position. So what you can do there is you can look to go, okay, well, the average, or not the average, but over the past 10 years, the high on gold or the low on gold is usually formed on a Wednesday. Okay, so if I'm trading mean reversion, why would I be trading before a Wednesday? Because it just doesn't suit the strategy. I mean, of course, these are all just ideas, so I'm not trying to change the way anybody does anything. I'm just trying to put ideas out there that make you question the way that you do things, and potentially things that you might not do, or things that might be holding you back a little bit. When we're looking at a trend following strategy, Monday is probably the best day to enter. And I'll pull TradingView up just so that I can make this point. I've also been swerved on this position, which is great. Happy days. So what I mean by this is if we go, we have 5 days of the week. Oh, great. So if we say we have our 5 days of the week, Monday, Tuesday, Wednesday, Thursday. What am I even doing? Monday, Tuesday, Wednesday, Thursday, Friday. Okay, so what we might see is that this is what happens on a Monday. And if it's going to be a bullish week and therefore the trend is bullish, we see the low of the week formed on a Monday, and then maybe you get the peak on a Thursday, and then we close bullish for the week here. So the best entry might be on a Monday. Whereas for a mean reversion trader, they need to let the trend play out. So they might be looking for a trade to revert to the mean on a Wednesday or a Thursday as the trend has played out. But again, this is all about knowing your edge, knowing your statistics and data on your edge, and being able to play those probabilities. So not just saying that this setup over here is the same probability as this, is the same probability as that, is the same probability as that, and it's the same probability as that. Again, going back to Atu's example, where this day for him, this Thursday, he's made 222%, whereas on the Monday, he's lost almost 9%. These trades are definitely not the same in probability or in expected value, and you need to know that so that at least you can risk accordingly. A bit of a long-winded explanation, so I apologize for that, but I think it's always good to get a visual explanation in. Let's move it back over there. I hope that makes sense also. So duration versus profit by trade. This is interesting. So this basically measures how many pips you take on a position based on how long you're in the market. So what's interesting for me is that you have a really high expected value. Actually, no, you don't. It's 50-50. So you have a 50-50 expected value here. Then when you're in the market for 30 minutes to an hour, you have 100% expected value. Now, that's only 100% because you don't have any data on the left-hand side, which is unfortunate. But the longer you're in the market, it seems the worse your edge performs. So you can see we kind of clustered down here, whereas we're a little bit more sporadic. Then where this becomes sporadic. This becomes a little bit more clustered. So this just tells me the longer that you're in the market, the worse your expected value gets. And if we take a look at here, so this duration, this is showing trades within the duration of 10 days and 16 hours to 21 days and 8 hours. You haven't won a single trade when you've been in the market for that period of time, but you've lost 1, 2, 3, which means you have, again, it's only because you don't have any trades on the right-hand side of this chart, but you have 100% negative expected value. The next time frame, which is 5 days and 8 hours to 10 days and 16, you've won 3 trades and you've lost 1, 2, 3, 4, 5. So you're 5 against 3. So again, you have a sub 50% expected value here. And so it's just about, again, highlighting where your edge is better and where it's worse. I would argue the longer you're in the trade, the more you should be sweating, right? It looks like around here is your hot zone. And then as you're in the trade for longer, I would be potentially looking for ways to exit the market. Not in a, I'm scared of giving what I have back, but just by your data, the longer you're in, the more likely that it's going to be a losing trade. Okay, this is interesting. Well, actually, no, it's not, because you do have a very small payoff ratio. So what I was going to say is it looks very similar to a grid or martingale strategy just because of how large these red candles go. And this is your maximum positive and negative excursion per position, which will measure how far a trade goes against you and for you whilst you're in the trade. But because you have such a small payoff ratio, it's actually not surprising that the red candles are just in general larger than the green side. Of course, you've got these couple over here which are larger than the average, which is about 2.79%. But your worst negative excursion is 6.67, which shows us that you have a negative risk to reward system, which means you need to keep up this high win rate, which, you know, it's completely possible. Again, not saying it's a good or bad thing. The only thing I would look at is take a look at, and again, this is something that I apologize if I sound like a broken record at this point, because the guys who join these sessions every week, like Reed and Snowy, must get bored of me saying the exact same things. However, I'm going to continue to do so because, well, it's my job. But what I would be doing is looking at this. I would go, let's potentially draw a line like this, right? You have 1, 2, 3, debatable, 4, 5, 6, again, debatable. You've got about 6 trades here, which are anomalies, right? I would say that this yellow line is your average. Oh my life, that looks like a child's written this. Whoops. Your average maximum adverse excursion or negative excursion, as shown up here. Now, what I would be doing is I would review all of these trades. This 1, 2, 3, 4, 5, 6. I would look at all of these trades and see if anything stood out about those individual positions that wasn't present in the rest of these trades. What made these trades go so far against you compared to your average? Because it's not as in you have loads past this line. So your median negative excursion is 0.13%, but your worst is 6.67%. I would be trying to investigate why that is so much bigger than the average. So why is your worst negative excursion so much bigger than your average? Is it something that you do wrong as a trader, i.e. moving your stop and letting the trade run too far against you? Or is it just that on those days that there was a black swan event or heightened volatility, or you traded through NFP and therefore Aussie dollar absolutely caked it? I would be trying to find out what that is. And the reason I'd be trying to find out what that is so that future-proofing your strategy, you can reduce your maximum adverse excursion to this average. Anything that goes past here, I mean, which ones have been a winning trade? This one looks like it was a winner. Can't tell where the black line is on there. Nor that one. I would basically be trying to eliminate all of this drawdown, all of this negative price action. I'd be trying to eliminate that. Similar to what has happened over here. you can see you're pretty much staying within your average now. So I don't know if you have changed anything based on that, but that's the only thing that I would be looking at here is if I was to cut off all of my trades at this average negative excursion, would I be more profitable or would I be less profitable? Because there's no telling how far these candles are going to go. The earlier, okay, so Alpha Wolf has said the earlier phases were all tested. Okay, great. It does look like you made changes because this, I'd say from here on, all of this period here is very consistent, whereas this is a little bit sporadic, even to the upside as well. So this is kind of what we would want to see, and this is a little bit too sporadic. No problem. Alpha Wolf said this is insightful. Thank you. I hope it is insightful. Sometimes I feel like I'm just rambling on, and that you guys are going to get bored, but is what it is. I hope I bring some value to you guys. Okay, so your value at risk. It's a little bit high, I'll be honest with you. Over the years, and bearing in mind Darwinex has been around for 13 years, what we have seen is that most traders with a value at risk of above 30% eventually end up blowing up. And when I say blow up, I don't mean, you know, getting margin called and losing the entirety of their account. It can be a significant drawdown that's just, you know, kind of impossible to come back from. It can be physically blowing up the account, but 36% value at risk is quite high. Now, again, going back to our example of the S&P earlier, which is what we risk adjusted everybody to, that has a maximum value at risk of 6.5%. Now, this is a rough calculation, and it's not exactly the way it works, but I'm going to give you a rough kind of calculation just so that you can understand the correlation between the two. So if we say that 6.5% equals a maximum drawdown on the S&P of, I don't know, let's say, what should we say, 15%? I'm going to say 20, but that's going worst case scenario. So let's just say 6.5 equals 15%. Now, if we go 36.61 divided by 6.5, so you are technically 5.63 times more volatile than the S&P. Okay, now if we go 5.63 times 15% max drawdown, you're looking at a potential of 85% drawdown. And again, this isn't an exact figure. I'm not saying that you're going to go into drawdown by 85%, but what I'm saying is with the exposure that you're taking, if you were to measure the volatility of the S&P, you could be looking at an 85% drawdown, which is kind of like you can't go back on that realistically. I mean, I've seen traders do it, go into 80% drawdown and then make it back. But I would want to be looking to reduce this, right, to like 20, 30% absolute max. Now, if we went, I don't really know how to work that backwards. Let's go divide this by 3. Oh, no, I don't know how to do it. What I would say is try and get your value at risk under 30% at least. Usually, like I say, 30% is kind of the cutoff. Anything above is kind of where I go. I'm a little bit concerned. Maybe it's time to tune it down slightly. If you can get it to 20 to 25%, perfect. But it's going to take some time to do that, right? And you don't have to do it. You don't have to listen to me. This is, again, it's all just me planting seeds and talking out loud about what I see from a data perspective. And again, we have to take what we've seen over the years from other traders and relate it to how it looks compared to your system, right? Now, to reduce this down, you're going to have to reduce your size, simply put. So your value at risk is comprised of 4 different things. So it's you're currently figuring out. Okay, so Alpha Wolf said, currently figuring out how to factor in value at risk. Okay, so the things that affect your value at risk is the assets that you trade and the volatility inherent in those assets, how often you trade, so your trade frequency, how long you hold those positions, and your position sizing. So effectively, to reduce your value at risk without looking at your position sizing, you need to trade less volatile assets. You trade Aussie dollar, so it's, you know, it's not crazy volatile anyway. Ideally, reduce the amount of positions that you take. So your trade frequency, the less trades that you take, the lower your value of risk would be. And then reduce the holding time on your positions as well. Now, that's all well said and done, but the problem is with that is you don't want to just change your strategy and change the way you trade just to suit value at risk. It doesn't make sense. So that leaves us with the fourth option, which is your position sizing, which is usually the issue of most traders. It's not that they're trading a stupidly volatile asset and they're trading it too much. It's usually just based on the exposure they're taking from a notional value perspective, as in they're trading too much size. And the reason I say that is because you could be trading, the least volatile asset in the world, euro dollar, for example. You could be taking one trade per year and you could be holding that trade for 20 seconds. You basically have zero market exposure, right? So your value at risk should be like negative. You're not taking any risk at all. But if you're trading that with 100,000 lots, it just counteracts everything about your strategy, which is why position sizing is the easiest one to play around with. So what I would say is try and see it as like the next 3 months, you're going to try and reduce your value at risk. That is your goal, right? Just reducing your value at risk. And this is at signal account level, right? So your Darwin will always be risk adjusted anyway to 6.5% BAR. But at signal account level, just for you and your mental clarity moving forward and your longevity, just try and reduce it slowly. See like a 3-month plan, maybe even a 6-month plan, where you reduce this over time. So I don't know what lot size you're trading with right now, but let's just say it's a 10 lot. You go, well, my goal is to trade, a tenth of the size. So I want to reduce it to a 1 lot. So we go, okay, over the next 6 months, what we're going to do is we're going to set out a plan. Every trade that you take, slowly reducing that position sizing. So instead of dropping from a 10 lot to a 1 lot and kind of blowing up the risk engine and the risk engine going, well, all of a sudden this trading behavior's changed. It's going to take me a month and a half to catch up to what you're doing anyway. We start reducing it slowly. So we go from a 10 lot to a 9.9, to a 9.85, to a 9.7, to a 9.65. And we do this gradually over an extended period of time. And the reason we do that is because, again, going back to what I was saying about VAR at the beginning, is it takes a 45-day look back period, compares it to a 6-month average, which you actually have the data for. So it checks that you're not being over or under leveraged based on your previous 6 months worth of trading history. And it will then calculate your value at risk in this present moment in time. So if you're reducing it slowly, your average starts to come down. So what the risk engine doesn't do is it doesn't, crap the bed and be like, oh my God, this guy's now taking a 1 lot when he usually takes a 10 lot, which means he's now trading tiny size on his Darwin. It will basically keep your Darwin as consistent as possible as you're adjusting your size over an extended period of time. And this goes for the guys who want to increase their value at risk as well. I mean, I don't see why you need to unless you're using the track record from your Signal account, as in your broker statements or a connected MyFX book, unless you're using that to, as like a CFE, like a CV to go and approach hedge funds or investment banks or whatever it may be. I'm going to check one more statistic before we end the session. So I do usually go on to Darwinex.com and take a look at the metrics over there, but we don't have time for that today because we've been talking about other different things as we go. But you can view your Darwinex Zero Darwins on Darwinex.com. So what you have to do is you have to log in. You can create a new login, or you can use your Darwinex Zero login to access Darwinex.com. And then once you've logged in, /Darwin, /your 4-ticker Darwin, and then put a hashtag at the end. Don't know why, but the hashtag makes it work. And you get access to all of these investable attributes up here, which basically rank different parts of your strategy or your approach, breaks it into their own little attributes and scores you out of 10 on each individual one. So for example, we can see here market correlation, you have a 6.1 score out of 10, which I'll be completely honest is quite low for an FX trader, which basically measures how well you trade both directions in the market. So usually and the reason why I say is quite low for an FX trader is because usually the only traders who we see with a low market correlation score, long only stock and ETF traders, because they don't trade a downwards market or a bearish market as well as they would trade a bull market, which is kind of common sense, right? But you have all of these different attributes. It's worth going to Darwinex knowledge base. We don't want Darwinex Zero, we want Darwinex. Darwinex docs, help.darwinex.com. Is this the one? And then going to where is it? World of Darwinex. Should come up with the knowledge base. Where is it? Let's go capacity. Help.darwinex.com, and then you can search the attributes. I'm just going to load one up here. Okay, so it was in World of Darwinex. So it's in investment attributes. So this will explain what each of these little investable attributes mean. I think some of them are really, really interesting to do a deep dive into. But again, you know, you can spend hours taking a look at these, so we don't have time to do that today. For example, we have capacity, which measures your alpha cap of your strategy. So how much investment your system can actually handle, which is the one that I was going to take a look at now. So if you take a look at your capacity, you're 7.1 out of 10. So what this does is we measure your toxicity flow of your orders, and then we take a look at if investors were to allocate capital to your strategy, what amount or investment amount would investors start to see a worsened performance based on slippage and spreads and stuff. So we measure, you can see here, the divergence between your Darwin, which the last, I think this calculates it every, I think it stays like a few days delayed. So the last time this was calculated was Monday this week. Your Darwin was up 8.37%. But if your investors were getting 2 pips worse slippage on every trade, they would only be up 2.97%. Now, what we do is we cap your Darwin off after the we know your investors will be getting 0.2 pips or worse slippage. And again, we do that by looking at the toxicity flow of your orders and calculating how much flow could go through that. So if you had 1 million, fine. If you had 10 million, fine. If you had 50 million, we wouldn't be able to fill the orders because of the toxicity flow. That's where we would measure the estimated slippage, and that's where we would cut you off and work out your alpha cap. Now, this isn't actually too bad. And if we scroll down a little bit, we have capacity, max estimated investment. And you're currently sat with a maximum AUM of 36 million US dollars. So you would be able to trade, manage 36 million US dollars of investor capital using the strategy that you trade right now, which is fantastic because you know that you don't have to worry about filling up your capacity over the next 5 years, 10 years, because, you know, hitting 35 million or 36 million would be great, right? It's a great problem to have, and it's probably going to take you a few years before you even come close to that. And at that point, you'll probably be able to pay people to come in, take a look at your strategy, and suggest ways to increase your max investment. But it's a difficult one to kind of cover because I see a lot of guys with low max investments, and it usually comes from when they're trading lower time frame stuff, and it really is just common sense things. Like, there's no one answer here that suits every single trader, but it's like common sense things: trading more liquid assets, holding the trades for longer, trading it with a bit of a larger stop. All of the different things that you kind of think would affect it generally do affect it. But again, we have all of this sort of information broken down on the knowledge base, where we go into detail about what the capacity is and what the other attributes are, and how you can use them to improve your strategy. So we're going to call it a session there. I think we've been over some great stuff today. I want to say thank you to Alpha Wolf and Rapalas for sharing their Darwins, and we will come back to Rapalas's Darwin when it's got a little bit more history. Alpha Wolf has said, I've been testing against a live Amanda account as well, so that works out well. Great. I think it's always good to test between brokers and see if, you know, selfishly from a trader's perspective, see if there's any arbitrage opportunities there that you can trade between the two brokers. Rapala said, thank you, of course, much appreciated for your insights. As always, dude, you know, I love doing these sessions. It's a great opportunity to take a look at other traders, to understand how people approach the market, and to just get to chat to you guys, which is fantastic. So I'm going to love and leave you all here. We'll be back tomorrow at 4 p.m. for the Darwin explanation session, or the understanding your Darwin session, I should call it, which is where we deep dive things like value at risk and your exposure in quite a complex and in-depth level, as opposed to what we've done today and the session on Tuesday. So I hope you all have a fantastic evening, and I will catch you tomorrow at 4 p.m. UK time. if you didn't catch all of this session and you want to watch it back, it will be available on X and YouTube too in a recording format. So peace out, guys. Have a fantastic one, and I'll catch you in the next session.